Assalamu alaikum. Hi there. I am Dr. Hassam, lecturer of accounting in International Program of Accounting, IPAcc QMA. The IPAcc students are conditioned to be superior and have characters. The academic environment that shapes them among lectures, assignments, discussion, presentation using international language. Our guest lecture, professor, visiting companies, students exchange, credit transfer that make them global minded. I can speak Indonesian, but I always speak English as international when teach and discussion with the students to formalize them with the global atmosphere. The enthusiasm of students, the seriousness of program manager, and a conducive environment, for sure IPAcc alumni will be a superior in accounting profession with Islamic values.
Currently, the advanced economic condition and the rapid acceleration of technological developments require businesses and organizations to manage economic resources and higher quality information as the basis for making the right decision. A controlled financial system is one of the success factors for an activity both for individuals, companies, and even countries. That is the role of an accountant. Do you want to be a part of that? Do you have global orientation? International Program of Accounting or IPAcc Universitas Muhammadiyah Yogyakarta answer this challenge. International Program of Accounting or IPAcc Universitas Muhammadiyah Yogyakarta is one of the undergraduate study program under Accounting Study Program, Faculty of Economic and Business, Universitas Muhammadiyah Yogyakarta, and is one of the leading study program with accreditation excellent from BAN PT.
Assalamualaikum warahmatullahi wabarakatuh. I am Professor Ridhuan, Dean of Faculty of Economics and Business, Universitas Muhammadiyah Yogyakarta. I welcome you to the International Program of Accounting. This international program is a leading international program in Faculty of Economics and Business, Universitas Muhammadiyah Yogyakarta. IPAcc has produced competitive graduates that have get good job international, also national. It has a job in the government institution, government-owned companies, and also the international corporation. IPAcc is very committed in providing best education for the student, that it is competitive globally and nationally. IPAcc has a large collaboration with universities overseas, where we can send the student for the exchange student in Malaysia, Thailand, Taiwan, Korea, Japan, and Spain, and other countries also, and also Turkey. IPAcc student is a competitive student. They join a lot of competition and they win the competition also. IPAcc is very productive in producing student with a big achievement. IPAcc student is very active. They have a lot of visiting professor, they have exchange student, and also you have the opportunity in IPAcc with a dual degree plus with master. You can study 3 years in IPAcc and add 1 year in Asia University Taiwan, then you can get your bachelor and also sarjana economy in UMA and bachelor at Asia University. And you have another 1 year in Asia University that you can get MBA over there. It's a very good opportunity and it's a very good chance, and then you will get it in IPAcc International Program of Accounting. I really encourage you to join IPAcc, that for you to have a good future. Thank you so much. Assalamualaikum warahmatullahi wabarakatuh.
International Program of Accounting or IPAcc is a special class that uses English as the language of instruction for students who are globally oriented, who plan to work in international companies or organizations, work abroad, or continue their education to abroad university. Currently, IPAcc emphasizes learning on business mindset in the digital era, where in this era, It takes an accountant who can build accounting information system and digital-based accounting audit. The presence of digital era is of course also balanced with the formation of Islamic character. IPAcc students are required to participate in student exchange, credit transfer for one semester, and can participate in double degree program in Universitas Muhammadiyah Yogyakarta International University Partners. Undergraduate students will get title Bachelor of Accounting or SAK, and with double degree, student can get 3 academic degrees consist of Bachelor of Accounting or SAK, Bachelor of Business Administration or BBA, and Master Bachelor of Business Administration or MBA within 5 years. It is intended that students get international experience, both academic and non-academic.
Accounting Study Program, Faculty of Economics and Business, Universitas Muhammadiyah Yogyakarta, has the mission to become an excellent study program in the fields of accounting and business, as well as mastering science and technology based on Islamic values. In achieving such objective, organizing a qualified accounting and business education with international standard will be a must. Efforts for internationalization leads us to some programs not only in pursuing academic excellence, but also in broadening the collaboration with international reputable institutions to provide students with international exposure. International Program of Accounting, IPAcc, is our program designed to prepare talented leaders in accounting with global perspectives. The activities cover visiting professors, summer school, outbound exchange students, and one promising fast-track double degree program in Taiwan. We believe that IPAcc is a great opportunity to be taken for accounting students. Supporting the tagline Young and Global, we provide millennials and holistic accounting.
What benefit will you get if you join IPAcc, which are: first, opportunities to participate in a student exchange at partner universities around the world. Second, opportunities to do work internship program at financial institutions and government institutions. IPAcc students will be an expert in English by getting intensive English course for 4 semesters and proved by a TOEFL certificate. Fourth, international community service. Fifth, international summer course. Sixth, visiting professor class.
Facing the globalization era, Accounting Department developed an international program of accounting, commonly called as IPAcc UMY, that a class that delivered by English speaking. Initiated at 2014, IPAcc grew faster to always updating internationalization issues. We came with some unique exercises to make sure our students having both national and international experience. By joining our activities such as double degree, summer course, student exchange, visiting professors, and other international activities, our students will have a memorable experience and many overseas friends that make them having large connection around the world. So come join with IPAcc and let us try to develop ourselves together both in accounting and international experience.
IPAcc alumni who graduates with qualification working in the financial sectors such as Financial Service Authority or Otoritas Jasa Keuangan OJK, banking, private, government companies both domestic and abroad, and institution under the Finance Ministry.
Hello, Assalamualaikum warahmatullahi wabarakatuh. My name is Aditaman Purhoputra. I graduated from International Program of Accounting, Universitas Muhammadiyah Yogyakarta as a Bachelor of Accounting. Currently, I'm working as a foreign bank junior supervisor in Otoritas Jasa Keuangan. Alhamdulillah, I'm happy as a part of International Program of Accounting UMY, or we call IPAcc UMY. I feel enjoy while studying with full facility, good friends in college, and also the professional lecturer. Studying in IPAcc UMY, I have also increasing my soft skill by doing credit transfers. Well, that's all experience in IPAcc UMY. Thank you. Wassalamualaikum warahmatullahi wabarakatuh.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. I am Abdul the alumni of IPAcc 2015. Now I work at PT Wijaya Karya Persero Tbk, especially in high-speed railway contractor consortium project, as a staff of finance and human capital. During work in Wika, the role of accounting and IPAcc UMY was very important in carrying out my work, not only because good accounting curriculum, but also a change to study or practice outside the campus. And the important thing is the Islamic environment. Moreover, many lecturers, many professional lecturers, they're ready to guide you in the process to be an excellent and Islamic accountant. So for me, choosing international program of accounting was a choice that I never regret. Thank you. Assalamualaikum warahmatullahi wabarakatuh.
Hi, my name is Yashvita. I am IPAcc alumni 2014 and I'm working at Kejaksaan Indonesia as an auditor. This profession is the knowledge which I ever received in IPAcc. IPAcc provides growth environment where we use class, we use English book, and IPAcc provides a good curriculum. Besides, communication between the students and lecturer are good so that the learning objective could be accomplished. Recently, IPAcc has exchange program that is good for students' development. Last but not least, I would like to say thank you to all accounting lecturer, especially IPAcc, for providing a good place to learn for us.
Let's reach your dream with IPAcc Universitas Muhammadiyah Yogyakarta. IPAcc UMY, Global and Holistic Accountant. Yogyakarta. The soul of Java. The cultural richness kept maintained, bearing unpretentious souls, creating young intellectuals who are ready for the world. HUE, Born Muhammadiyah Association, a progressive Islamic organization, engages in various fields of life. One of them is education. By the idea of Professor Dr. Kahar Muzakir on the 1st of March 1981, Universitas Muhammadiyah Yogyakarta presents to enrich young intellectuals' competence, actualizing Muslim scholars who are noble, competent, confident, able to develop science and technology, useful for the nation and world developments.
Accounting Department Universitas Muhammadiyah Yogyakarta is a leading accounting department in Indonesia. This department has got A accreditation since 2005, when only a few accounting departments can get this accreditation status. There are many achievements that students have received. Winner in a number of capital market competition, winner in scientific competition, and recently winner of National Enterprise Resource Planning 2018 competition. That 5 students of this department will represent Indonesia to compete in Singapore. Therefore, this department has produced competitive alumni that they can compete in job market while maintaining Islamic values. I believe by joining Accounting UMY, you have made a very good decision to be a successful person in this world and the hereafter, inshallah.
Accounting Department of Universitas Muhammadiyah Yogyakarta was established in 1992. Our mission is to produce Bachelor of Accounting who master in science and technology, have a good characters, integrity, and global insight. To support the graduate competence, we provide extra services such as training and certification, like Islamic banking training, taxation training, internal audit training, external audit training, and most management training. Meanwhile, we also provide certifications such as Enterprise Resource Planning from Munsun SIM and Associate Certified Public Accountant from Indonesian Institute of Public Accounting. To face the business changes in the era of Industry 4.0, the curriculum of Accounting Department focuses on ability to utilize information technology and ability to take strategic decisions. We expect that Accounting Department can keep contribution in producing human resources who are excellent, Islamic, and have a global insight.
Universitas Muhammadiyah Yogyakarta has set up a new tagline of Young and Global. In order to speed up this mission, the Department of Accounting proposed to establish International Program of Accounting Universitas Muhammadiyah Yogyakarta. This program is expected to be the driving force for continuous improvement in providing better services and facilities in education system at the accounting department. The increasing needs of graduates with good qualification and international recognition drive the accounting department to focus on developing main competencies of technology information, international financial reporting standards, public sector, and Islamic accounting. Under the professional management towards the world-class quality with a vision to become a global-oriented accounting department by focusing on strengthening faith and piety to Allah Subhanahu wa Ta'ala, mastering science and technology of accounting, and being the center of excellence which is beneficial for people. With the missions of being actively involved in the nation's development process, enlightenment of people through 3 pillars of higher education, in creating young, noble, and global accountants. Since 2005, Accounting Department Universitas Muhammadiyah Yogyakarta has been accredited A. The establishment of academic atmosphere and the development of competitive character are improved continuously. As a result, the public trust to the accounting department is even higher, which could be seen from the large number of applicants. Learning in the accounting department of Universitas Muhammadiyah Yogyakarta is supported with good quality of supporting facilities, such as library, where students can access the relevant and appropriate references, such as e-journal and e-book. Administration room, where students get administrative services, and Wi-Fi area, laboratory for practicum, in Kiai Haji Ahmad Dahlan Mosque. Accounting departments also directly supervises Accounting Students Association, which can serve as a facility for students to develop soft skills in the fields of organization and self-development. Besides supported by qualified facilities, academic atmosphere is also established by the certified lecturers academically and practically, who are actively involved in academic and professional activities nationally or internationally, as an effort to renew the accounting science ode. The learning process also refers to the competency-based curriculum, referring to Indonesian National Qualification Framework, through learning method approaches of centered learning, discussion, presentation, and problem solving. Accounting department also tries to create prospective accountants who are professional, responsive, confident, creative, trusted, and innovative on each graduate student of Accounting Department of Universitas Muhammadiyah Yogyakarta. Various efforts carried out by Accounting Department, such as providing supporting facilities and establishing cooperation with domestic and foreign agencies, are parts of the process to create a conducive academic atmosphere and increase the achievement.
Assalamualaikum warahmatullahi wabarakatuh. Good morning, everyone. This is General Lecture. As our speaker, Mr. Mara Ridhuan Abdul Rahman. If everyone are ready to start, I will open the session. Before start, I remind you to open your camera and mute your audio, and don't forget to replace the name with the full name. Jika semua sudah siap, saya akan membuka sesi ini. Sebelum memulai, diharapkan kepada semuanya untuk menyalakan kamera dan membisukan audio, dan jangan lupa untuk mengganti nama dengan nama lengkap. The Honorable Mr. Mara Ridhuan Abdul Rahman, BAc, MAc, PhD, as a speaker for today's event. The Honorable Dr. Hassam Alden Riyad Al-Aziz, MSA, as a moderator for today's event. And the Honorable Accounting Lecturers and the participants who attended today's general lecture. Alhamdulillahirabbil alamin, wassalatu wassalamu ala asyrafil anbiya'i wal mursalin wa ala alihi washabihi ajmain amma ba'du. Praise your glorious presence of God Almighty, who gave his guidance and mercy of Allah to all of us so that we can attend the general lecture event with the topic Financial Statement Analysis as a speaker Mr. Mara Ridhuan Abdul Rahman, organized by International Program of Accounting on this morning with healthy step. Blessings and greetings, let us always devote to our Lord, the Prophet Muhammad, who had brought us from the time of Jahiliyah, heading into the era that is full of inayah. Let me introduce myself. My name is Anissa Balkis as the Master of Ceremony. Here, I would like to show you about the agendas we have arranged today. The first agenda is opening. The second agenda is general lecture session. The next agenda is Q&A session. The next agenda is photo session. And the last agenda is closing. Let us start the first agenda, that is opening, by reciting Basmalah all together. Bismillahirrahmanirrahim. The next agenda is general lecture session with the topic Financial Statement Analysis. This event will be guided by our moderator, Mr. Hassam. He is a foreign lecturer who are teaching an expert in financial information analysis subject. For Mr. Hassam, time is yours.
Okay, thank you, Anissa. Thank you so much. Assalamualaikum warahmatullahi wabarakatuh. Good morning to everyone. Special morning for our guest visiting lecture, Dr. Mara Ridhuan Abdul Rahman. Assalamualaikum, sir. How are you today?
Waalaikumsalam, Dr. Hassan. I'm good. Malaysia is a very beautiful weather today. Alhamdulillah.
Alhamdulillah.
Especially.
Alhamdulillah. First of all, we are going to welcoming our speaker, and I just would give you some of, let's say, some briefing about our guest lecture profile. Dr. Mara Ridhuan, he's obtained his doctoral degree from UK in 2012 from Newcastle University, and also he's obtained his master in accounting in 2001 from UKM University Kepansingan of Malaysia, and also he's get his bachelor degree in 1998 from same university, and also he has a wonderful history career. In last August in 2020, he's appointed as head of postgraduate program up to present, and also he's a programmer coordinator for Bachelor of Accounting program since 2013 up to 2020. And also he's a senior lecturer from 2013 up to present. But he started his career is earlier when he working after his graduate from bachelor degree as a tax assistant for 1 year from 1998 up to 1999. His field and his specialization incorporate reporting that mainly focus on voluntary narrative reporting, and also his research interest, his research area, which is he's doing research and supervising the student in the area of social media reporting, financial literacy, and risk reporting. Then he have many graduate students from PhD program and also from master program. And around total is 7 students, which is ongoing, and 5 students, which is already graduate, and many of undergraduate students. He achieved a lot of silver medals from his university and from some exhibition. And also he has wonderful publication profile, which is already published more than 24 articles and 5 book chapters. His Google Scholar, which is really high, which is almost more than 600 citation, and his high index is 9. It is pretty good and pretty cool. Then hopefully we are going to start with him, and our students, sir, are excited to listen and get benefit from the session. And we hope we will have a fruitful discussion, and I'm sure we will get a lot of benefit from our guest speaker. So the time is yours, sir, and our student listen to you carefully. Please, the time is yours.
Bismillahirrahmanirrahim. Assalamualaikum, my brothers and my sister, and thank you, Dr. Hassan, for introducing me. So very, I think it's a very long introduction. Okay. So I'm glad to see you again. To all, I consider you are my student today for 2 hours. So I remember that last time I was invited as a guest speaker. I mean something like accounting theory. Okay, so 1 year ago, 2020. And I'm glad, okay, to be invited here again. So thank you very much for the UMY for inviting me. And today, actually, I was asked to present a topic about, or not to present, actually, to share. It's the basic idea or basic knowledge about a financial statement analysis. Okay, let me share. Okay, let me share my slide. So can you see my slide?
Yes, sir.
All right.
It already appeared.
I need to enlarge it. Okay. Today's slide is about more than 40 slides. Okay, it's quite lengthy slide, but because I'm given about less than 2 hours from now, and I promise I will stop at any slide on time. Okay, so at any slide on time, because sometimes when we are sharing lecture in accounting, it's really unpredictable in terms of time management. Sometimes 10 slides it may take 1 hour, okay, or more than 1 hour. That's a common, the common duration of accounting I think Dr. is Bruno. Okay.
Correct, sir.
All right. Am I right? Okay. So the financial statement analysis. Okay. So basically, when we talk about financial statement analysis, you must understand that financial statement analysis does not tell everything about the company. Okay. So from the overall pictures of a business analysis, financial statement analysis is just a sub-analysis. Okay, sub-analysis of business analysis. In order to understand the overall picture of business, we need to perform a bigger context of analysis. Okay, we will call it as a business analysis that normally can be categorized into quantitative analysis and qualitative analysis, right? And sometimes we cross each other. There's not absolute classification between quantitative and qualitative. Sometimes quantitative also involve a qualitative analysis. So in quantitative analysis, the financial statement is located here. Okay, it's located here. Even though it's sub-analysis, but it's very significant for decision making or for the business evaluation. And also consists of industry statistic. Okay, industry statistic that normally issued by industrial report. Okay, for example, like automobile industrial statistic, or sometimes produced by Ministry of Statistics, and also economic indicators, source of analysis that normally produced by Ministry of Economic or by non-governmental economic body. Okay, and also the trade report. Trade report is normally produced by Ministry of Export and Import, and is special for is meant for company involved in the import export trading. So this is what we consider as a quantitative analysis. Okay, to understand the financial condition, the perspective of a company, we need to contextualize the company by the broader context, okay, or by associating many more source of report or document. All right, and this is very critical in business analysis because it provides you with the very objective, fact and factual data. Okay, a statistical data for a business and its environment. And another analysis we consider as qualitative analysis, okay, which consists of management discussion analysis that you can found it in the front end of no report. So normally management discussion and analysis, or sometimes we call it as management outlook. Sometimes we call it chairman's letter. You know, it's basically they discuss about the key indicators of past performance or any management intention in terms of strategic planning or evaluation of the risk and opportunity. All right. So this is a very important source of analysis actually, even though it's discussed in the we call it more relaxed manner. Okay, but it's a key point that representing the intention of the company. And also the financial press release that a company normally perform, they release up-to-date information through the newspaper or website, and also information that you can get from regulatory filing. For example, company that listed in the stock market, so they need to file update information to the stock markets, like change in the board of directors, change in the CEO, so change in the major shareholders, and etc. That is another important source of information of business analysis. And also vision and mission statement, which I consider is not really significant. So our focus is here, financial statement analysis. Okay, financial statement analysis. But as I said, to be well-rounded business analysis, you have to perform, you have to go through all the document, all the source of document, okay, to get a better understanding about a company or a firm. And then I would like to point out here is about the ESG, environmental, social, and governance. Because in the modern business model, okay, in the modern business model, they're not only profiting the shareholder, not just giving a higher dividend to the shareholders, but they also benefiting the environment, the social, and also comply the good practice of governance. Okay, is the performance in terms of environment, social, and governance, corporate governance, is aiding or creating a value to the company in the long term. Okay, this is a factor, three factors that are very important to ensure the sustainability of the company. Therefore, company nowadays, okay, is also on top of the financial statement. The company nowadays are evaluated in terms of ESG, how they perform ESG. The Western country, for example, if you want to invest internationally or in a Europe country, or if you want get a loan or get a financing from West country, you need to show, you need to prove that you are well performing of ESG. And this is the information about ESG cannot be found in financial statement. It's beyond financial statement. Okay. So there has been some development of reporting that telling about the ESG performance. We call it as integrated report, and also corporate, we call it sustainability reporting. This is a very popular topic nowadays. If you're accounting student, I believe you used to be came across with the topic of the sustainability reporting and integrated report, very comprehensive reporting. But of course, it's not mandatory. If you practice, it if adding value to the company. But we are here today not to talk about the sustainability reporting and integrated reporting, because we only focus on the financial statement analysis. And what is financial statement analysis? And I think I believe that everybody know what is financial statement. Okay, it consists of a statement of financial position, profit and loss account, cash flow statement, statement of change in equity, and not to the account. That is we call a statutory or mandatory financial statement that need to be prepared for any company, okay, in any country, okay. And therefore, financial statement is a document for the financial statement analysis. And before you do financial statement analysis, you have to ensure that the credibility of financial statement, because the quality of financial statement depends on the quality of the quality of analysis is highly depend on the quality of financial statement. If financial statement is credible, it was prepared with a true and fair, will lead to the better analysis. Okay, so financial statement analysis means quantitative and qualitative process of identifying strength, weakness, risk of the firm. So it's basically a process involving that you need to split content of financial statement into many components, many meaningful components, and then you try to establish the relationship between the components that later on give you meaningful data for interpretation and eventually for the good decision making about investment, about lending, and so on and so forth. So, what's the purpose of money? To assess the past and current performance. Okay, depend on you. How long you want to analyze, 3 years or 4 years. Okay, and also to predict the net income and growth. Okay, it's depending on the formula that you use. assessment of the lending of risk. Okay, of course we will perform about the risk of lending in terms of solvency ratio, and of capital structure. Okay, we look at that, and also predict the bankruptcy and failure. I'm not good at this. I don't know how to predict the bankruptcy and failure for a financial statement. So you need many documents to predict the bankruptcy and failure. Okay, not rely on the financial statement. So, before we move on to the technical aspect financial statement analysis, let me start with what the business activity and how the business activity relate to the analysis of financial. Whatever business you are doing, or whatever type your business entity, whether it's a company, partnership, or enterprise, okay, basically there are three business activities, and these three business activities is interrelated to each other. The financing, the financing, how the company get the money from investment, from issuing share, or from borrowing from the bank. Okay, and they got the money, they start to invest on the capital expenditure, and some of it on the operating expenditure. Okay, when all the assets are ready, they start to operate, and they get money, paying debt, okay, and making additional investment. And of course, all of these activities require planning. And therefore, when you are analyzing financial statement, you're actually not making judgment about the financial statement per se. You are actually evaluate and making judgment about the business activity. Okay, business activity. Performing about the investment, performing about the financing, performing about the operation. So, in financial statement analysis, you must integrate all this activity into your financial statement analysis. And how to get this data, how to get this information about the activities, of course, from financial statement. For example, investment. Okay, is reflected in the balance sheet under the current and non-current asset. For the operation, okay, it is reflected in the profit and loss account and the cash flow, what it is, and how you manage the cost and other expenditures. For the financing, get information from the balance sheet. Okay, and then you need to focus on the liability, current liability, non-current liability, and also the statement of shareholder. Okay, and importantly, remember that it needs to be integrated to each other. Okay, so having understanding function of financial statement analysis and what is a financial statement now, I think we can move on to the type of analysis. Okay, type of analysis. So basically, there are a few type of analysis that we came across in the. Of course, if you are specializing in finance, there are a lot of financial statement analysis and evaluation. So basically, in accounting, we only focus on financial statement analysis. Okay, but if you are focusing on finance, okay, coursework, maybe they can go further by looking at the valuation, not just analysis, but evaluation, prediction, and so on and so forth. But of course, I'm not covering that kind of topic here, so because I'm not a finance expert. So first of all, it's a comparative analysis, which is considered horizontal analysis, it's trend analysis, we call it, or vertical analysis, or it's common size analysis in other name. be it ratio analysis, cash flow analysis, valuation analysis, as I said, stock analysis, and so on and so forth, and management accounting analysis that involve even point, safety margin, variance analysis, um, uh, and of course, this is internal based analysis. This analysis is not based on the published financial statement. You cannot do management accounting. Public cannot do management accounting analysis because no data available to perform that, only for the internal purpose. Our focus is only on the comparative analysis and ratio analysis, okay, that focus on the published financial statement. Okay, let's start with the horizontal analysis. What is a horizontal analysis? It's a trend, okay? The trend analysis to look the longitudinal performance of a company. So this basically is involved comparing between current year and previous year. Okay, the purpose is to evaluate of the constitutive of financial statement. So you can see the direction, whether move upward or move downwards, the speed. I mean the speed of the quantum of the increment, 5% or 10%, and the extent of the strength. Okay. So in horizontal analysis, you must remember that some people said, to what extent that we can track the analysis? For how long we can track the analysis? Very subject question. 3 years, 4 years, 5 years, 10 years. Okay. It depends on the purpose analysis actually, or it depends on the account that you analyze. For me personally, I believe that horizontal analysis, the longest one is 5 years. The longest one is 5. Otherwise, you waste your time to analyze over 15 years because data is too outdated. Okay, the data is too outdated to help you to make inference about the financial condition. It's not relevant for you. Let's say you want to do the analysis since 1918. Okay, for me, just 5 to 3 years is enough. Okay. This is, for example, the comparative income statement. You can see here that, for example, net sale increased from 2005 to 2006. Sorry, the example is that outdated. So this net sales increased 7.3%, and then you can see that the increment is stable in terms of sales and cost of sale, okay, around 7 to 6%. But unfortunately, there is a significant declining in terms of profit. Okay, operating profit declined to negative 2.44%, and you can find that it's because of the significant increase of the other expenses. So other expenses is 169%. Okay, so by having the horizontal analysis, actually you can comparing between who are you compared to the yesterday. Okay, compared to the year, and whether you make it your company better or you make it your company worse. And you can scrutinize which part that contribute to the increment or to the increment. The second one is comparative analysis. Okay, so basically the comparative analysis involves the evaluation of internal makeup of funds. I mean, it's like a piece of cake. So every slice goes to somewhere, goes to somewhere. Who eat the first slice? Who eat the most slice of the cake? Who eat the least slice of the cake? All right. So you basically look at the proportion of the component in financial statement For example, income statement. Okay, the net revenue, okay, must be base of the common side. Okay, common sum, which is 100%. And cost of sale consists of, in this case, 45.4%. And the remaining 54.6% goes to the as considered as a gross. Okay, and then gross profit minus 32.6% of the sale is for selling and general and administrative expenses, and other expenses is 0. This is because of positive, we consider the if negative is the income. Okay, so the common size analysis will help you to determine the portion of the component in income statement that make significant changes to your position and performance of the company or financial statement. Okay, for example, we can see that there is no much change in terms of cost of sale. Okay, it's around 45%. Okay, around 45%. But the thing happened on the maybe on the where here. Okay, it's also unstable in terms of selling, general and administrative expenses. Not much change in terms of proportion. Okay, you can see that from 2002 and 2006, the proportion of component in income statement is quite stable. Okay, and the common size analysis can also be performed with the balance sheet. Okay, to look at the proportion of the, for example, current asset and non-current asset, current liability and non-current liability, proportion between a liability and equity, and so on and so forth. So, and remember that the common size also can be done through the horizontal analysis. Of course, in common size, you can make the asset 100% the base. So in this case, the current asset consisting of 36.1%. But it's not really matters here. Okay, the common size or the horizontal analysis not really matters. Third one is a ratio analysis. Okay, this is a very important analysis for you to not carry out, not to perform, but also how to interpret the ratio analysis. Okay, and what is a strategy that can be taken to improve the ratio analysis. Okay, the ratio analysis actually to evaluate the relationship between two or more economically important items. Okay, economically important items. One starting point to further analysis. Okay, so the output is mathematical expression of relation between two or more items. Okay, so basically, we try to establish a connection between one or two components in financial statement. For example, I give you some analogy, simple analogy. You see 100 students. Okay, you see the 100 students, and at the same time, you find that the library has a 10,000 square feet, 10,000 square feet in space. So this information, if by individual or by standalone basis, okay, does not give you any meaningful information, isn't it? 100 students and the space, square feet of library. But when you combine it as one analysis, and it make useful information for you, you can find that the usefulness of the library in terms of how it serves the people or how it serves the student, based on the ratio that you can say, the ratio between the space of library and number of students. One student is equal to, let's say, 15 square feet. The ratio of one student is 50 square feet of library. The larger the ratio, the comfortable the student. Okay, this is how we connecting between individual figure to another individual figure to give you more meaningful uh, expression of the data. And of course, please be put some cautions because prior accounting analysis is important, which is we need to discuss. Okay, ratio analysis can be divided by profitability analysis, liquidity analysis, working capital analysis, and solvency analysis. So now let's start the profitability analysis. So profitability analysis is a joint analysis which one measure is assessed relative to other measure, just like okay. So basically, profitability analysis can be referred to as a return on investment, okay, or return to invested capital. Normally, we're familiar with the ROI. Okay, it's familiarly known as a ROI, return on investment. So ROI is related income or other performance measure to a company level of source of financing. Is measure how company perform or how company generate income given the capital, given the provided capital bank. So the benefit of ROI, so you can make a comparison between a few alternatives of investment opportunity. Let's say you have the 3 projects. Which project that give you higher ROI, and you just select. Of course, the ROI is not the only indicator, okay, to help you to make a decision. You anticipate other ratio analysis. And as we understood, normally riskier investment give more ROI. Okay, I mean more gain, more risk, isn't it? No gain, no risk. More gain, more risk, less gain. Sorry, less risk, less gain. So if you can convince your creditors, your investor, by higher ROI, so you can get financing or the soft funding easily compared to the lower ROI project, right? So ROI is applicable to measuring managerial effectiveness, measuring profitability, and measure for planning and control. Because ROI is the important KPI, it's a common KPI in any business or any economic organization. Because ROI, okay, is set up by management, and every management must responsible to achieve the ROI. Okay, and sometimes ROI is tied up with the bonus. ROI is tied up with the incentive to the management. That is the reason why management is really eager to achieve the ROI. And in achieving ROI, of course, you need the skillful, resourcefulness, strategies, people in organization. And also, as I said, ROI is measuring profitability, all right, that tie up with the bonus and other incentive. And ROI also require coordination, okay, between unit in organization. Of course, every unit in organization need to plan that to achieve the same ROI of the company, need to achieve the brand ROI or the master or ROI. Whatever you do in a unit, make sure it's consistent with the brand ROI. So, what's component of ROI? So by formula, we can see that ROI is income divided by invested capital. What's income is of the many interpretation. What is capital? Also, there's many definition about capital. So either income is referred to the total income, or income is only referred to the operating income, or income to need to be specific on a certain project. It depends on the purpose of the evaluation. Okay? Also capital. What is capital? Is capital referred to the fixed asset? Is capital referred to the asset, operating asset, non-operating asset, or is capital referred to the equity share? Okay, it depends on the purpose of analysis. So I need to go faster actually. So normally when people performing ROI analysis, they refer to the net operating asset and stockholder equity. Both are representing capital. Okay, both are representing capital. If I investor and I want to invest the company, so I may use I may consider capital as my equity, shareholder equity. But if I am manager of the company, okay, and I want to invest in certain project, the capital now is not based on the shareholder, based on the equity share. My capital is now based on the money that I put on the project. Okay? Different perspective of the ROI. So net operating asset. In this case, in this topic, we refer to the net operating assets first. Perspective is that of the company as a whole, called as a return on net operating asset. When you are management of the company, okay, when you are and you want to calculate ROI, you must focus on the return on net operating asset, because only operating asset that generate revenue, revenue. Of course, other asset like a securities or investment do not generate the core revenue, but they generate other income. That's why you need to split between operating asset and net, between operating asset and non-operating asset. Okay, and what is operating asset? Operating asset is a total asset minus investment in securities. Okay, investment in securities and debt. So, and then in terms of equity capital, okay, the formula is just divided net income less preferred dividend. Okay, this common equity capital is done based on perspective of the common equity shareholder, not based on the management or company asset. Okay, the formula is the net income less preferred dividend. Why you minus preferred dividend? Because you have to ensure that net income is distributable to the equity shareholders, exclude preferred dividend shareholder, and divided by average common equity, and you get how many percent of the ROI. Of course, when you are comparing your ROI, whether it's good, bad, better, okay, not on the it cannot be evaluated on a standalone. You need to compare with the previous one. Okay, you need to compare ROI with the industry. Okay, and or you need to compare with your targeted ROI. So remember, when you evaluate ROI, it must be contextualized. Okay, it must be contextualized or must be compared. Okay. All right. So now let's go back to the ROI based on the operating asset. The formula is operating income. Okay, NOPAT times by NOPAT is the net operating income after tax divided by beginning net operating asset plus ending net operating asset divided by, because we need average, right? And you get a figure how many percent of the ROI based on the net operating asset, or called return on operating asset. And in terms of return on common equity, I said net income minus preferred dividend divided by the average equity, and average equity can be obtained by adding beginning and ending equity divided by 2, and you get how many percent of the return on common. Okay. That is analysis of profitability. Analysis of probability, as I said, depend on the net operating asset or depend on the profitability ROI can use net operating asset or can use equity, depending on the perspective of analysis, whether you are management or whether you are outside the investor. So, return of operating asset is actually, if you can be break down into two other formula. Okay, net operating, okay, return on net operating after tax divided by average net operating asset is equal to the net operating income divided by sales multiplied by sales divided by average net income. Remember that this is measure profit margin. Net income divided by sales is a profit margin, and sales divided by average net income called as a turnover, asset turnover. And therefore, the ROI is a function of the profit margin and asset turnover. In order to get a higher ROI, you have to ensure that either profit margin increase or asset turnover increase. Asset turnover is how many times you can sell the asset every year. Okay, sometimes we call it asset volume. So for me, if you want to increase ROI, either you increase the margin. How to increase the margin? Either you increase the price and control the cost, and you increase the volume of the sale. I mean the unit number of the sale, the unit of the inventory that has to be sold, okay? Or combination of both. Okay. If you want to reduce the margin, make sure you increase the volume of the sale. But if you think that you cannot increase the volume of unit sold, make sure you increase the margin by increase the price. Okay. So as I said, ROI is function of the margin and the volume. So this example, okay, this example how the relationship between the margin and the volume and how it affects to the ROI. So sales, we are three scenario here. Sales 5 million, 10 million, and also 10 million. And net operating income, okay, this is a net income, 500,000, 500,000, 100,000. And this is an operating asset, 5 million, 5 million, and 1 million. And therefore, when you calculate, margin is 10%. The margin is 10%. Can get income, net income divided by sales, 500,000 divided by 5 million, you get a margin 10%. And in terms of turnover, okay, sales divided by asset, 5 million sales divided by asset 5 million. That means every 1 ringgit asset, okay, every 1 ringgit asset contribute to the 1 ringgit sale. Now, asset turnover or asset utilization is 1. So ROI, the function of 10% multiplied by 1. So it gives you 10%. Okay. In second scenario, the margin is 5%, but asset turnover is 2. 5% multiplied by 2 is this gives you net operating income 10. Right. So what I was trying to say is that you can play the figure, you can strategize your business. Either you increase the margin by increasing the price and control cost, or okay, you can increase the volume, the unit volume of your sale, or a combination of that in order to achieve your target ROI. That is a profitability analysis. The second one is about what is this? Right. Gross profit margin reflect the gross profit as percentage of sale, and it reflect company ability to increase or to maintain selling price. All right. And then declining margin. If the margin increase over the years, either you capable to sell your product at a higher price. I mean, even though you increase the price, but the product is acceptable, it's demanded at the market. Okay. Or but sometimes you decrease you found that there's a decrease of margin profit margin, which is indicate that the company is trying to reduce the price. The company trying to reduce the price is indicate that there's a high competition in the market. Okay, that force you to reduce the price, or because your product less demanded because of high competitive market. Okay, so as I said, declining profit margin, okay, must be covered by increased sales unit volume, ensure to maintain the ROI. So we've done the profitability analysis. The second one is a liquidity and working capital analysis. Liquidity and working capital analysis is a short-term analysis. Okay, it's focused on short-term analysis. Unlike the profitability analysis that refer to the how company is performing during the last year, the liquidity and working capital analysis actually is refer how company manage its liquidity in terms of getting cash and in terms of paying short-term commitment. Okay. Liquidity. What the liquidity means? Liquidity means is ability of the company to convert asset into cash or to obtain cash to meet short-term obligation. The more cash or the quicker you get cash, the more liquid the company is. Company is said to have a very low liquidity if they hold asset, large asset in terms of inventory or receivable, because there is no right proportion of the current asset. Some company hold too much inventory, less asset, less cash, which is its liquidity is less favorable compared to the company hold much cash than inventory. But of course, company hold more cash than inventory indicate that the company will generate less income compared to the company hold more inventory. Isn't it? Because if you hold even more inventory, you can make more sales and you can generate more profit. It's not wise to hold more cash than inventory in certain cases. But of course, if you hold less cash, you cannot meet the liquidity requirement. You cannot pay the suppliers on time. You cannot pay the operating expenses, and of course, you will distort your efficiency of your daily operation. And what is the working capital? Working capital is the excess of current asset over current level by formula. Working capital is where you're comparing between current asset and current liability. Of course, a good working capital is when the current asset is larger than the current liability. You can see that negative or positive working capital. The working capital is referred to the capital that needs to be used on a daily basis. Okay, on a daily basis. So, what happens if company suffers liquidity problem or lack of liquidity? First, company may lose advantage of discount. If you don't have enough sufficient cash, you pay late. You delay or you postpone the payment. Of course, you will lose the discount. You could not be able to buy the inventory in the large volume. And of course, you may lose your discount. And you may lose profitable opportunities. Sometimes you get good potential of project, good potential of business, but because of the lack of cash, you cannot materialize the project. Okay, you cannot take the opportunity, okay, to take the project. And of course, you lost the profit. And it's management action. Some reflect poor management of cash, reflect the poor managers in managing the cash. And coverage to current obligation cannot be met, and in large extent, the severe illiquidity, will lead to the lower profitability because you cannot take advantage in terms of economy of scale. Okay, cannot buy in bulk purchase, and restrict opportunities, and sometimes may involve a loss of owner control. Okay, loss of owner control. What I mean that you may sell your business to others because of not capable to pay debt, and loss of capital investment, and the worst case is the solvency and bankruptcy. That's important thing for you to manage your liquidity. Now, how to measure liquidity? Okay, how to measure liquidity? So, ratio to measure the liquidity is referred to the current ratio. Current ratio is comparing between current asset and current liability. What is current asset? So, current asset is that referred to the asset can be realized or can be converted to the cash within normally 1 year or 12 months times or operating cycle. And what is the current liability? I mean the commitment, the obligation that needs to be settled within 12 months from the reporting date. So normally, there's no universal or accepted ratio for current analysis. I mean current liquidity. It depends on the industry, actually. Depend on the industry. But this is the rule of thumb that the current ratio is 2/1. That means 2 current asset to 1 current liability. Every $1 current liability, you must have $2 current asset. Now, if you have a 2/1 current ratio, it can be considered that your position or your liquidity in the right or in the safety zone. Okay, in the safety zone. So, quality of current asset and composition of current liquidity are more important in evaluating the current ratio. As I said, sometimes the current ratio, okay, when you divide it between current asset and current ratio, say you have 3/1. So, but of course, that's not the sole indicators. That's not the absolute good indicators of the liquidity. You must go deeper by looking at the component of the current asset. As I said, between cash, the component of the cash, account receivable, and inventory. So even though all are current assets, but in terms of liquidity, they give a different speed. They give a different speed. The receivable and inventory, of course, receivable is superior than inventory. That can be converted. If company has a more inventory but very less cash, okay, compared to the company that has a more cash inventory. Because we can say that even though the total current asset is the same, but the component of the current asset is different. So give a different different indicator of the current ratio. So, and then working capital requirements vary with industry condition and the length of company net trade cycle. For example, retail versus automobile, retail company, working capital within week or 2 weeks, because every inventory that you buy from supplier need to be sold within 1 week or 2 weeks to get the money, So, but liquidity for the automobile is more longer. It could be 6 months or more, Nobody can sell a car within 1 week, it takes longer. So there's a different interpretation of car ratio depending on type of industry. And this is some example of car ratio calculation. Okay. The car ratio for the liquor company is computed below. We compare between current asset and current liability. In 2001, current asset and current liability is 2/2.2. Okay, 2.2. That means every $1 liabilities is equal to $2.2 current asset, which is good. And the current ratio improved in 2020 from 2.2 to 2.6. Okay, the larger current ratio, the better. Okay. All right, and then of course some limitation current ratio. Sometimes current ratio is a static measure. It does not really predict the future cash inflow. Why? All right, because when we do current ratio analysis, we take current asset, isn't it, at the value of the reporting date. Okay, at the value of reporting date. But actually, the value of current asset at reporting date do not actually reflect the future cash flow that will be arising from the current asset. It looks like we're comparing between current asset with the future liability that we need to pay. Okay. For example, we take a marketable securities. Marketable securities is a current asset. Okay. So marketable securities, we report the fair value, market value, and we need to pair with the current liability. And of course, marketable security subject to the estimation and it changes over time. It's changed over time. Doesn't mean that you report the doesn't mean that the value of the marketable security today, let's say 1,000, is equal to 1,000 next year. Okay, it could be declined. But the liabilities never decline. Okay, the liability not subject to the short-term liability. I mean, not subject to the valuation. And some accounts receivable is subject to revolving. Why is revolving? Because accounts receivable can be extended to another receivable. Therefore, the credit term is extended. So it keep going extension, it keep going extended, it keep going revolve. So it doesn't give any meaningful measure of the current ratio if the account receivable is keeping extended under revolving nature. And inventory, for example, inventory is reported at cost, but it's sold later at a profit. It's mismatch between inventory reported at cost and inventory that going to be sold profit. So there's not match between the current asset, value of current asset in terms of inventory now and the current value, the value of inventory in the future. Okay, and of course, no inventory value to market is 10% anticipated in the future, and also prepaid expenses, dubious liquidity from the prepaid expenses. Some expense, we know that the prepayment is a current asset, and sometimes the prepayment cannot be converted to cash, like a prepaid insurance, right? So it doesn't make any sense for you to compare or to calculate the current ratio by including the prepayment expenses. Cannot be converted to cash in ever mean. Okay, ever mean. Even though you surrender the insurance, you cannot get insurance prepaid because it's burned. That's a limitation in current ratio. Okay, because of that limitation, some people are proposing alternative measure of liquidity, which is we call it cash to current asset ratio. They only take cash to current asset ratio is alternative measurement to quality, where they only take cash equivalent and marketable security, which considered as the most liquid asset. Cash is of course liquid. Cash equivalent is already liquid, and marketable security is easily liquid. It's easily convertible to cash anytime, and divided by current asset. Look the proportion of the cash and cash equivalent over the total asset. Okay, I mean the larger ratio, the more liquid of the current asset. Second formula is a cash to current liability ratio. Right? Comparing cash equivalent marketable security over current liability. Okay, to look the relationship between cash that company has and the current liability that company oblige. Of course, the larger ratio, the more cash available to pay the current cash. In this case, they exclude inventory and accounts receivable because they consider that inventory and accounts receivable suffers lack of liquidity, especially when come to the situation of economic of not really encouraging. Because when the economy is poor, so it's very hard to collect the accounts receivable, and so very hard to sell your inventory. It suffers liquidity problem, okay, during the economic turmoil. Okay, now we see in the liquidity analysis. Now we go to the accounts receivable liquidity measures. So accounts receivable liquidity measures by formula, or we call it accounts receivable turnover. It's a measurement of how liquid the accounts receivable, how fast we can convert accounts receivable to cash, or it's telling you about how fast you can collect accounts receivable from your customer. Okay, or we call it as an account receivable turnover. By formula, net sale. Okay, net sale of credit, credit sale, not cash sale, net credit sale divided by average account receivable. And account receivable turnover can be converted to days by 360 divided by account receivable turnover. In this figure, 360 days divided by this figure. So please have a look on the example. Okay, account receivable turnover, net sale divided by average account receivable. And how to calculate account receivable, average account receivable? Beginning account receivable plus ending account receivable divided by, right? The higher ratio suggests the faster collection. Okay, this example for the Lincoln company, the net sales given for 2002, 2021, 2022, 2021. And this is account receivable, beginning and end. Okay, ending and beginning of account receivable. Total is 235 and divided by 2, you get the average accounts receivable is 1.7. And sales account, sales divided by accounts receivable, you get accounts receivable turnover for 2002 is 12.7. And accounts receivable for 2001 is 9.2. That's mean 2000. This positive performance of accounts receivable turnover, because in 2022 the company is collecting accounts receivable more frequent than 2021. In 2022, average company can collect 12.7 times accounts receivable. Faster collection, more frequent collection compared to 2021. This indicates that the company has a good mechanism to collect the payment from customer. Or you can convert into days. Okay, you can convert to days. 360 days divided by 12.7 accounts receivable turnover. Now the answer is 28.3 days. That means this company can collect accounts receivable every 28 days. Okay, and of course it's better compared to 21, because in 2021 it collect every 39 days. The longer of days you collect, okay, the more problem of liquidity that you will suffer. Okay, that you will. The second one is other than the receivable turnover, we can also analyze the liquidity in terms of inventory turnover. So basically, inventory turnover is a measurement to indicate how fast or how frequent company can sell their inventory in a year. Okay, in a year. So by formula is a cost of goods sold divided by average inventory. Average inventory is, of course, you adding beginning and ending inventory together divided by 2. And the higher ratio suggests more frequent sale, which is better. So this liquid inventory balance at the beginning of 2001 is 311,000. So this is cost of goods sold, and this is average inventory. Okay, in 2021, inventory turnover is 2.8. Okay, cost of goods sold divided by average inventory. Inventory turnover is 2.8. That means in 2001, so in a year you can sell inventory almost 3 times a year. Okay, 3 times a year. But in 2002, the inventory turnover is much more better, because increased to 3.8. Or can interpret that in 2022, the company can sell inventory, or the company can sell inventory almost 4 times a year. And then this inventory turnover you can convert into days, into days calculation. Formula is, okay, 360 days divided by 2.8. 2.8, yeah. Okay. And you will get 128 days. And 2022 inventory turnover is 95 days. So how to interpret? In 2021, the company sold the inventory every 128 days. But in 2022, the company managed to get it shorter. That means the company sold the inventory in every 95 days. The shorter the number of days, the better. The shorter the number of days, the more liquid the company position, the position of company liquidity. Okay. So interpreting inventory turnover, low decreasing inventory turnover. Why inventory turnover is decreasing? I mean, you take more time. Okay, you take more days to sell your inventory because of poor quality of inventory, maybe because your inventory is out of season or inventory shortage. Okay, or increasing the price. You increase the price of less demand from customer. And all because of poor inventory management. Sometimes you over purchase the inventory. You don't have a very systematic inventory management like GIT. So you never anticipate the inventory purchase with the expected sale. That make your inventory is dumped at the warehouse. Okay, of course, there are costs of keeping inventory in the warehouse, which contribute to the higher operating costs and contribute to the lower profit later on. Okay, so now having understanding on the days sales in receivable and days sales inventory, can do further analysis on the conversion period of the receivable and inventory. That means how many days altogether from cash to get cash from sell inventory, buy credit, and to get money from the receivable collection. In this case, let's say this receivable is 75 days, this inventory is 120 days. Conversion period is 195. Okay, the company takes 120 days to sell inventory, and the company has to wait another 75 days just to collect money from the account receivable. Altogether, the company took 195 days just to get cash. So, for interpretation, okay, you must interpret that the longer of the conversion day, the better for liquidity. And the company, okay, and the company must strategize, must plan how to reduce the conversion period to a manageable level of days, okay, in order to achieve the safe liquidity level. Okay, and then liquidity of current liabilities. Now look at the liquidity of current liabilities. We just finished liquidity of the current asset. Now we look at the liquidity of the current liability. So basically, liquidity of current liabilities not refer to the how fast you collecting cash, but it's refer how fast or how good you pay your current liability. Okay, you pay your current liability. So it's measured by account payable turnover. Okay, to look the liquidity of current liability, can perform account payable turnover analysis. So, by formula, account payable turnover is cost of goods sold divided by average account payable, and you can convert account payable turnover to the account payable turnover in days, okay, like this. Okay, 2021, 2022, there's a cost of goods sold, and this is average of account payable. The average of account payable is adding beginning and ending of account payable divided by 2. And then cost of goods sold divided by average account payable, you get 2.4 in 2021 and 2.8 in 2022. Okay, what's telling you? Okay, telling you is that in 2021, you managed to settle the current obligation 2.4 times a year. And it improved in 2022, where the company managed to meet the current obligation, more frequent than 2021, is 2.8 times a year. Can convert to days, okay? And also convert to days. In 2001, company only pay current liability or settle current liability every 150 days. And improve in 2002, the company can settle the current liability only 128 days, means 22 days shorter than previous year. So what are benefit of having a lower account payable turnover? Or in other words, what make what are advantage of paying or settle liability is quicker than before? Okay, of course, your creditor is happier, and then okay, by paying more faster, you make your creditor is happier than the previous year. So in business, establishing a good relationship with the supplier is important for you to keep your business sustained. Because if your supplier not happy, your supplier is not happy, you won't get any supply, and you cannot get any. You cannot make any sale. That's the reason. And of course, you keep delaying payment, and will disconnect a good relationship between the company and the supplier. And which one better? Because 120 days is better. But some people say that if you can prolong the credit term or the days of settling the current obligation better than paying faster, because the we call it the account payable is a free financing, because account payable is non-interest bearing financing. Okay, so you have to optimize the credit term or the credit duration. Okay, if the creditor gives you 30 days credit, make sure you optimize the 30 days. Don't pay earlier than 30 days, because you will lose the free interest financing. Okay, you will lose the free interest financing. This is some perception or some opinion about the delaying the payment to the creditor. Okay, and then there's some formula, or there's some method to test the relative liquidity level between the current asset and the current liability. You see, we are comparing between the number of days you collect the cash and the number of days you pay the creditor. So we call it as a net trade cycle. So net trade cycle tell a company how many cycles it goes through in a year and how many dollars are tied up in each cycle. Or in other words, it's measure how many days cash is tied up in accounts receivable, inventory, and or account payable. The formula of NTC is based on the previous formula. Okay, number of days money is had in account receivable, inventory, and account payable. Of course, all you need is account receivable days plus inventory days minus account payable days. In other words, you have to calculate account receivable turnover, you have to calculate inventory turnover, and you have to calculate account payable turnover, but all in days, Then, account receivable days plus inventory days minus account payable days, you get whether positive or negative number. And the smaller NTC is the better. When NTC positive, a company needs to fund those days with the net income or line of credit. When NTC negative, a company is being paid for product services before the company pays its current payable, and this is advantageous to the company. So you might not understand at this stage, and until I show you the illustration here. Okay, this is data given. Don't bother about this. Just focus on this. How we we are arriving at the NTC. First, you have to calculate accountable turnover. Okay, accountable turnover by days, and the answer is 40 days. That means cash tied up in accountable for 40 days. The second one is you calculate inventories turnover by days, and you find that 56.24 days. I mean the cash is tied up in inventory for 56 days. And you plus accounts receivable days and inventory days altogether is 96.24 days. Okay. And account payable turnover in days is 30 days. So 96.24 days minus 30 days, net trade cycle is positive 66.24 days. Positive. No positive means it's not good. Positive means it's not good because your cash tied up in accounts receivable and inventory is much more longer than you pay accounts receivable. Okay, it takes 96 days to get the cash, but only it took you 30 days to pay the liability. So the shortest is 60 days that you mean 60 days without cash. 60 days without cash that you need a credit line facility, okay, to support your working capital. So make sure, or I can say easily that I put in a simpler way, if I can. Let's say let's say you sell a product to customer, 30 days credit. Okay, that means your customer have to pay within 30 days. But you buy a product from suppliers with 10 days credit. In other words, you need to pay your supplier in 10 days. This is mismatch, isn't it? It's a positive NTC. Customer pay you within 30 days, but you need to pay supplier within 10 days. So the NTC is 20 days positive. So you are in the state of 20 days without sufficient cash. Without cash. When you are without sufficient cash for the 20 days, you need to borrow money, okay, from the credit line facilities like overdraft and so on. Okay.
Excuse me. Sorry, doctor, to interrupt you. Our time is almost over, but we may get 5 minutes extra.
All right. Okay. Last one about liquidity.
Okay, thank you.
I think I need to stop the solvency. Stop the solvency. Okay, current asset compositions. Another analysis to analyze the liquidity measures is on the common size of the cash. Okay, common size of the cash out of the total current asset. For example, you can compare between the position of cash between year 1 and year 2, and you compare accounts receivable inventory between year 1 and year 2, and you find that in year 1 the cash is 30%, year 2 the cash reduced to 20%. Accounts receivable in year 1 is 40%, but reduced to the 30%. The inventory from the 30% now increased to 50%. So what a conclusion or interpretation that you can make from this simple data? So it says that the analysis of factors electric common size percentage reveal a marked deterioration of current asset liquidity. Okay, it's a deterioration of the current liquidity in year 2 compared to the year 1. So because this is evident by declining in cash component, okay, from 30% to 20%, and declining in accounts receivable from 40% to 30%. That means much of the cash is tied up in the inventory, amounting 50%. So there's a simple method to analyze the liquidity level. And another liquidity measure is we call it as acid cash ratio or quick ratio, which is we only consider cash, cash equivalent, marketable security, and account receivable, and we exclude inventory in this analysis. Okay, in this ratio, and we divide it by current liability. And also we call it cash flow ratio, where we only comparing between operating cash flow over current liability, because we don't believe of the we don't believe the current asset. Because sometimes because current asset is it still takes time to convert it to cash, so we only focus on the current cash flow from operating, and then we divide it by current liability to see how much the current cash flow can serve the current liability. And okay, in terms of other than financial statement analysis, we can also evaluate the financial flexibility of company to meet the current obligation or to meet the long-term obligation by having or by looking at the management discussion analysis. You know, because in management and discussion analysis, the requirement for managers to have some not of discussion on how they plan to get a funding, okay, how they plan to ensure they maintain the liquidity of the company. So that is one of the source of information or source of document that we can rely on to analyze the liquidity level of company. And I think we stop here. I think we have to stop here. I not be able to continue with the solvency ratio. So thank you very much.
Thank you, Doctor. Thank you so much. We need more time to get more knowledge from you, Dr. Mara.
Yeah.
Hopefully we have another session in another day, maybe. Okay. Right now we are finished from the session, and we are going to move the session of question and answer. So please, our students are still there. Any question, please? You can address your question directly, or even you can typing, please. Time is yours. Any question, please?
Yeah, you can put your question in the chat box.
Correct. This is one option.
Yeah, if you try to ask me.
Okay. Any question, guys?
Sorry,
Okay.
I need to talk. I need to give a speech so fast, you know, so fast.
Yes, sir, please.
Time constraint.
Okay. Maybe they're still preparing the question. So may I ask or discuss with you about the financial statement analysis? I would asking you, Doctor, please, as you are expert in this field and expert with the long academic teaching, what do you advise of the student and how they should be learning financial statement analysis, especially in accounting? This subject is tough and not easy in this course. especially for the student who's taking this subject in third semester, as our student is taking the subject in third semester. So what's your advice or what's your suggestion to them to accept this subject easily, please?
Okay. Make it this subject easy, you mean?
Yes.
Actually, when we say about financial statement analysis, there are two approach of studying financial statement analysis. First, studying financial statement analysis from finance lecturer, no? Yeah. And the finance statement analysis from accounting perspective. Two different things. Okay, I think the finance statement analysis from finance perspective is much more easier than studying financial statement analysis from accounting perspective. Finance perspective never consider the variation or never consider the reporting standard, the variation method or disclosure issues in financial statement. For example, if they analyze the long-term liability, okay, finance lecturer never consider aspect of lease, capital leasing, never consider about the operating lease, never consider about contingent liability, never consider about LIFO or FIFO. Okay, so for me, you must start with the studying financial statement analysis from finance perspective first. Okay, from finance perspective. Don't bother about the FIFO, LIFO. Don't bother about the effect of operating lease, finance lease, or financial statement. Don't bother about the aspect of the we call it as off balance sheet financing. Okay, this topic is the specific issue in accounting that it make you difficult to understand the financial analysis. Go to the basic financial statement analysis first. Once you master in financial statement analysis, but okay, once you master in financial statement analysis, and then now you slowly anticipate, you slowly associate with the reporting or accounting issues in the analysis. You cannot avoid it because you are accounting student, you must consider the issues of financial reporting standard into financial statement analysis. As I said, the effect of market valuation, the effect of fair value on financial statement analysis, the effect of LIFO, FIFO on statement analysis. You know, what effect of impairment on the financial statement analysis. Because in accounting, we are given so much we call it method, isn't it, to adopt in the financial reporting, and this gives different implication on financial statement. Now, of course, this different indicator to the financial statement analysis. So the issue, that's I said, for student, go to the financial statement without anticipating or without associating with the financial reporting issue. Once you understand it, and you slowly associate financial reporting issues in financial statement analysis. Okay, actually, I want to share this issue at the last of my screen. But of course, we have no time.
Okay. Basically, I agree with you because the students still fresh and still they coming to the accounting field. It is not easy for them to deal with the numbers and with the reporting, annual reporting and financial statement reporting and income statement and so many accounting issue. So you suggest with the finance perspective first. Okay, I see. That's nice. Thank you so much.
Yeah.
I will back to my student, please. Any question? Any question, guys? We have 60 participants. Please, any question?
Please, any question? You can ask me through the chat box.
Yes. Yes, please. It is nice opportunity. We get
Or you
knowledge.
can ask me any general question you like.
Okay. Any question, guys? Okay. I will continue the discussion with you, Doctor, if you not mind. I just would asking how financial statement analysis is important for the companies and investor right now, especially in the post-pandemic. You know, after many countries also lock down, and we hear the news from here and there about the projection of International Monetary Fund (IMF) regarding the decrease forecasting of global economic production for 2021.
It's a really hard question, actually.
Actually, I just would to share and know your idea.
All right.
Because we are from different countries, so we are taking also some opinion from Malaysia.
All right. Of course, every company have been impacted by the COVID pandemic, right? So, but in business, I consider this pandemic is a non-recurring, no repetition impact.
Correct.
Okay, only happen in happen in 2 years, and the company will be recovered later on. So, but of course, being transparent, okay, even though this pandemic is just a temporary situation, but any impact on the company must be reported in financial, especially on the asset impairment. Okay, many companies close down their business. Many asset is underutilized, and there's a lot of discontinued operation. Operation discontinued that need to be reported in the financial statement. But of course, as I said, it will impact the company in the future, even though it happened only 2 years. So as a financial analysis, okay, you need to consider, you need to find out to what extent this loss, impairment loss, for example, will prolong. Okay, will prolong. But it's not easy to analyze. Sometimes it depends on the type of industry. It depends on the type of. Some asset I think is permanently discontinued, but some other asset is just permanently, just a temporarily impact. For example, let's say investment in security. Okay, maybe temporarily impacted. When I strongly believe will be recovered later on. Okay, so if you analyze the financial statement, don't put so much worry on the temporary loss on the investment security, because I strongly believe it will be covered. But if there is a loss on the impairment from, let's say, operating asset, that I think you should reconsider, okay, for your investment decision making, because many of the non-financial asset, okay, or operating asset is permanently discontinued. Okay, discontinued. So it's depend the type of asset. It depend on the type of industry. Dr. Hafiz.
I see.
All right.
Okay. Thank
Because
you.
the pandemic is not company specific problem, right?
Correct.
It's not company specific. It's overall. It's a global pandemic. It's global phenomena.
I see. That's right. Okay. Thank you. I back to the student. Anyone prepared question, please? Where is IPAcc?
Yes, sir.
Okay, so please. Who is this?
Ruth.
Okay.
IPAcc.
Yes, please.
Sir, from your own general reading and analysis, what do you think about the future of investors globally? Do you think the investors will go with which stream of economics, such as the development economics or development or emerging economic countries? Which one will be more attractive to investors?
Sorry, I'm not clear. It's not clear.
I was asking, like from your own general reading and analysis, what do you think about the future of investors globally?
Future of?
Like what do you think about the future investors globally?
Future investor in global?
Yeah.
This is not a financial science. I think this is economic analysis. You know, I'm not an economist, so I'll not be able to give the answer about the future. What happened in the future about global economic?
Okay. Okay, this is the question is more general and more outside of financial statement analysis. It is more economic analysis or microeconomic analysis.
Yeah.
Do you agree? Okay.
Yes, sir.
Okay. Thank you, Ruth. Thank you so much. Any question, please? Okay, if no question, then I'm going to thanks our guest, Dr. Mara, for this session, for sharing knowledge, and thanks a lot for your explanation about the financial statement analysis and about the general framework of business analysis, as well as the type of analysis, the purpose. And may Allah blessing you, and thanks a lot for you. Then I'm going back to the master of ceremony.
Okay, thanks to Mr. Mara for the attractive material. Hopefully, it can help the audience to have a better understanding of financial statement analysis topic. And thanks to Mr. Hassam as the moderator, who guided discussion today more clearly. Now, it is turning to the last agenda, which is closing. As master of ceremony, I do apologize for any mistakes during this event. Finally, I say thank you. Before leaving this event, kindly please everyone turning on your camera because we want to take a picture. Okay, ready? 1, 2, 3. Once again. 1, 2, 3. Thank you for joining this event and see you on the next events. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Waalaikumsalam warahmatullahi.